Welcome back to another video. This video is a part of the price action series on reversals and is the second video on reversals. Now, I'm not really fond of patterns in trading. I just trading off of patterns, but there is a few patterns that I'm going to teach and a few that is worth keeping note of and is worth knowing how they look, why they form, and what possibilities may arise once they form. So, in this lesson we're going to talk about the under-over and over-under pattern. These are sometimes incorrectly called head and shoulders or an inverse head and shoulders. They look the same to the untrained eye, but a head and shoulders, for anyone who doesn't know, looks like this, and an inverse head and shoulders looks like that. Now there's a difference which we will come to in a second, but the main difference is that the head and shoulders pattern, the main premise of it is that you have a neckline, which is where the trough before the final peak at the head, and then the second test of it forms a neckline. And when broken, you take a short. So you wait for the neckline to break and then you short it. Or for an inverse head and shoulders, you wait for the neckline to break and then you long it. But the over-under and under-over pattern are different, and I prefer them over the head and shoulders because they include an all-important market structure break, which means the neckline breaks before the right shoulder is made. Now you may ask, why is this important? It's important because that means we can get a better entry. Okay, we can enter at a better price due to the market structure break. Now you know what a market structure break is from the previous lessons on market structure, but for those who don't know or haven't watched my previous video, we'll cover it briefly again and then we'll get right into the over-under and under-over pattern. So here's a bullish market structure break, and the bullish market structure break you can view it through candlesticks or a line chart, but you're going to need candlesticks to see why in a second. You find the market structure break by looking backwards. So the easiest way to find the market structure level is to use the line chart and then flip it back to the candlesticks. For a bullish market structure break, you have to wait for a low to form. So this is actually a common question that I get by a lot of people. They're confused on how to spot it. They feel like they have to spot it ahead of time. Okay, you don't. You wait for multiple red candles and a low to form, and then for price to go above that low. So it looks like it might be a bottom. Nothing's confirmed yet, but it might be. At that point then you look back, where was the last green candle? The last candle before this low. And you mark your line across the candle close, hence why doing on the line chart gets to the exact level. The market structure break itself is the next time a candle closes above that level in the same time frame, of course, and then you have a confirmed market structure break. And the reason we use the last candle close of a green candle to find a market structure break is because it represents the swing high of the previous move. Okay, swing high into a low, we then break above that swing high, and for anyone who has seen the market structure lesson, you'll see why that is so important. If you look at a bearish one, it's the same thing, but obviously in reverse. Again, you find your market structure break by looking backwards, and this time you wait for a high to form, and then you wait. You see this high, this long wick, you see this next candle failing to go higher, and you think to yourself, this could potentially be a top. Again, nothing's confirmed, but that doesn't matter yet. I'm going to go back, and here's a red candle. There is the close of the candle. I draw my market structure line across that, and then the next time a candle closes below that level in the same time frame, it's called a market structure break. Again, line chart view, you can see the swing low, and the swing low gets broken. That's a high probability reversal. So that's a refresher on market structure break. Now let's look at a full under-over and over-under pattern. So let's look at the under-over first. So you might wonder, why the name? Why is it called an under-over? Well, that's because it goes under the low and then over the market structure high to complete the pattern. So on this line chart, we have the market structure level in a dashed red line. We have the low in a solid red. So for an under-over to form, the price goes under the low, that comes back up and goes over the market structure break level to shift the trend and give you a high probability reversal. Okay, that's simple. So why does it work? Regardless of the time frame you trade, and the principle of an under over and over under pattern is the same. It's psychology. You have trap traders, a higher probability trend shift, and a retest. So let's look at that. The under over obviously reverses and causes a bottom, and it works by trapping traders, but first you set a level, so price comes down and it sets a level. Then price drops below that level, trapping some traders, which is confirmed when price comes back above that original line and then closes above the market structure level, which indicates to the smart traders that there's a high probability that the trend is changing. That part, number 3, shift the trend. That will indicate to anyone that trades with price action principles to not short this and potentially go long, so it becomes self-fulfilling. It follows up with a successful retest of the first low, and that is a confirmation of control shifting into the bull's favor in this case. So if you look at it as the inverse head and shoulders, okay? If you want to use that phrase, you have your left shoulder, head, and then your right shoulder, and this part is a left shoulder retest. So if it hits the red line, it's retesting the left shoulder level. Okay, it doesn't always hit it. Again, nothing in trading is for certain. I need to look at it on the candlestick chart as well as the line chart. Here's the exact same under over, but it's on a candlestick chart. And you will see it's slightly different, and this is important. So the low, or number 1, is drawn from the wick instead of the candle close. So previously it was the candle close, now it's drawn from the wick. Now I personally prefer to use wicks for the lows because the whole point of number 2 is to trap traders. If you're going to trap traders, you want to do it below where their stop losses will be. Stop losses don't typically get placed at candle bodies. They typically get placed below candle lows. So I always use the wick for the lows, where the highs in the inverse, but always use the candle closes for the market structure break because this indicates more strength and reversal than just a wick. You understand that from the previous lesson on market structure on why the swing high must get broken. So very simple, candle bodies for market structure break, candle wicks for your lows and your highs that create the shoulder, head, shoulder or the over, under completed pattern. And there you have your 1, 2, 3, 4, which are principles I just showed above. You set your low, you trap your traders, you break market structure and retest. And there's your completed under over on a candlestick chart. Now let's look at an over under pattern. As the name suggests, it goes over the high and then it goes under the market structure level to complete a structure break. So again we set a level, this time a high. We trap traders above it, we shifted a trend by breaking below the market structure level, by closing, and we retest, which is confirmation that control has shifted into the hands of the bears. Another left shoulder retest. So this works exactly the same as the under over, and I've just shown you it in reverse. So the exact same principle as tops and bottoms, successful retests of the left shoulder happen, but not always. Don't expect to be perfect, okay? Again, nothing in trading is for certain. That's one important thing to know at this point, okay? You'll notice this one, even on the line chart, price goes slightly above the red line. And on the one before, price didn't quite touch it. I use these examples for a reason, okay? It's not supposed to be perfect. Don't get hung up on it touching the line perfectly, okay? And do not just automatically set orders at those levels because you'll see why in a moment. It is not supposed to be predictive, okay? You still need to wait for confirmation, then a retest to show control. Okay, you need patience. So this is the exact same over under on a candlestick chart, but there are some important differences. The retest of the previous high, the left shoulder retest, has a wick which goes above number 2. So that would have stopped out any traders who have gotten too early and put their stops above there. It's important to keep this in mind. Now this is the exact same structure. You set the high, you trap traders, you break your structure, and you have a successful retest. But there's also a long wick here. Important, okay? Never ever try to guess the pattern. You must wait for confirmation of the retest with a candle close. Okay, again, trading is a game of patience, okay? You need patience. Well, you wait for your confirmation, and then you act. So if you're patient and simply waited for this candle close, you would have seen that it was totally valid. The candle closed below the original high, and you could have entered easily there and would have had your valid over under pattern.